Good morning, good afternoon, good evening. Welcome to the Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend, and welcome to another episode. We are talking about tax return mistakes that we see frequently happen amongst our clients and the general public, and we're going to teach you about them and how not to make them. If you've never been here before, our podcast is broken down into 4 sections. You learn about us professionally, personally, we dive into content, and we answer questions. Before we move on, please pause the show, follow the show, subscribe to the show, like it, comment. And as I have a teacher as a wife, I'm going to say, do it now. It's your own time you're wasting. We're going to wait. And good. We're a financial services podcast, so we have a disclaimer. Jordan, take it away.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
First section of our podcast is called You Good. You learn about us personally. No, you don't. It's professionally. So, Heather, you good?
I'm good. One thing I noticed, so last week when we recorded, we kind of alluded hard week, right? One of the reasons I had a hard week was, in business, I mean, this is just having a business, but you don't really know when you need to change things until the thing happens. And I think I manage over 200 accounts. That's not clients, but that's how many accounts I manage. Mm-hmm. I needed a tax loss harvest last week. It ate up an entire day. I'm like, oh, this is not going to work for me any longer. And so, I'm in a much better mood coming after the week, right? Catching up after losing an entire day that you didn't expect. But I need to invest in more software. My coach always says, look at technology first. If technology can't do it, then you hire. And as this is my phase that I'm entering and buy back your time, that is now onto my tax plate. So I'm after tax return season is to look into more technology. Yippee. I'm kind of excited about it though.
Or you could not trade as often.
I mean, we have arguments about this. Well, that's not a now thing. We'll debate that later.
Okay.
How are you? What's going on?
No.
I said, what's going on? I did not say what am I not allowed to say now? How you doing? I'm not allowed to say that. I'm not saying.
You gotta say the two words.
Oh, you good. You good?
Thank you. It's a segment. Yes. Yeah. I got thrown a curveball by a professional this week that would have made up about 5 hours of additional work for me to do, and then realized I have hired an admin assistant. You do it.
Buy back your time. I was like, it's amazing.
Like, why am I stressing about this? Admin, this is your job. Go do it. And I felt so empowered. And I'm like, this is why you hired them. And they were on it. They're like, sure. What do you need me to do? When do you need it done? How quickly? I'm like, whenever you want. No, not whenever you want, whenever I want to. Do it by 2 days' time. You're like, got it. Yes, boss. I was like, thank you.
It's so funny that you, as a business owner, at least for me, it took me so long to be willing to delegate and trust someone else with my baby. Like my business is a baby of mine. And then once you kind of get comfortable, then it's like, oh, wait, this is amazing. This I'm going to offload. This I'm going to offload because it makes you better. All right. I'm so excited for today's episode.
All right, for those listening or watching, this has been a journey because Heather loves taxes. I enjoy taxes, but Heather, talk about having a third child. Taxes is the name of her third child. She has prepped this episode. She has done research. She's done hours into this. So when I say let's dive in, that's going to be the starting bell for Heather, and she's just going to go. Where this episode goes, who knows? So Heather, let's dive in.
So the amount of tax return mistakes I have seen in my career, holy fluff. I'd have to do 20 episodes on that. We're not going to go there. But today we are going to talk about the top tax return mistakes we commonly see, right? so that people don't make them, because you do not want to leave the IRS a tip. Who wants to do that? No. Okay. But where I want to start is the common theme I get from my clients and just talking to people is they are so unhappy with their CPA. Response time, planning, strategy, or even finding a good CPA. I mean, even on our financial advisor forums, how many times do you see in need of good CPA? And like, there's like maybe one or two responses, right?
Mm-hmm.
Do you find the same thing? It's really hard to find a good CPA today.
It is. I had a really good one, and then they sold their company, and then they weren't as good. And then I moved, and she was fine. And now she sold her company. And I'm just going through that journey over and over again. And it's not fun.
But you're not alone. And that's actually, so I did some research. This is some of my research because I'm curious, because I've been hearing rumbles of it in my CPA forums. So CPA Journal in the end of 2023 put out an article. The article was titled, "The Accounting Profession is in Crisis." Well, that's not good. Accountants are kind of important. So I dug deeper and wanted to find out why. So significantly fewer students have selected accounting as a major. And from 2016 to 2021, there has been a 33% drop of CPA exam candidates. Then the AICPA, this just gets worse, which is the American Institute of Certified Public Accountants, CPAs, 75% of its members are at retirement age. Like, if I could have,
That's a lot.
This is a problem. And then they go on to what's causing this. And it does make sense. I mean, so the starting salary for like finance and technology coming out of school is normally about 20% higher. Mm-hmm. Well, okay, who's going to go for the higher paying job? Also, the accounting images in like movies and TV shows, they're not the best images, right? They're normally people that don't have a life, are really nerdy, like work a lot, right? I don't know what you watch probably more TV than me. Am I depicting this correctly?
Have you watched the movie The Accountant with Ben Affleck?
Oh, of course I have. Oh, I love it.
Yeah.
Yeah.
That's not your typical accountant.
No. And then there's also this whole new 150-hour requirement where if you get the CPA, you have to go do an extra year of school, which that's expensive. But anyways, so accountants are becoming a rare breed. And also, so where TF started coming with the idea, TF is my firm, is, I worked in Big Four accounting and a CPA firm out in Seattle that did really high net worth clients. And the CPAs are freaking intelligent as all heck that I worked with. But their whole, one, charging what they're worth, they suck at it. Two, they're so busy with compliance, just getting the tax returns out the door and getting them correct. They don't even have time to plan or strategize. And many of them don't, and they don't charge for it. It's like, here's your tax return fee to do your tax return. So there are so many tax return mistakes or tax planning mistakes, tax strategy mistakes I have seen over the years. Big one that actually just came across my desk recently. Previous financial advisors putting retirees in mutual funds and then income these humongous capital gain distributions on their tax return. I mean, how many times have you seen this?
A lot. It's actually probably historical planning that people just haven't caught up with, because mutual funds were all the rage 20 years ago. And if you haven't been keeping up with investment trends to move over to ETFs, which essentially do the same thing as the mutual fund does, you're just subjecting yourself to more taxes for essentially having the same investment philosophy. It's redundant.
Well, and for those not listening, so ETFs don't give off capital gain distributions like mutual funds do. And what capital gain distributions are is basically within a mutual fund, you're buying many, many holdings, many stocks. And when the mutual fund investment manager sells holdings, or they have to sell holdings, even if you don't sell the mutual fund, you got to pay your portion of capital gains on that. If you're in an ETF, you don't have to do that. And I mean, I've seen clients with $50,000, $60,000, $70,000 of capital gain distributions, and they didn't sell a thing that they're having to recognize on their tax return. And I mean, we're going to get into it, but maybe we should just get into it now. Let's talk about net investment tax.
Net investment tax. Let's kind of do a quick explanation of what that is. So it's an additional tax that gets added on to your tax returns if you hit a certain threshold. So what is net investment income? It's interest, dividends, capital gains, rental income, non-qualified annuities. All those payments kind of lumped together. If on your tax return you cross a threshold of $250,000 as a joint filer with your partner, or $200,000 single, any investment income you have gets taxed an additional 3.8%. So if you are not careful, if you're getting close to that income threshold and you have a lot of investment income that's coming, you're just going to pay more taxes on that. So that's why you got to plan beforehand.
Right away, that's an easy planning thing. Get to ETFs somehow. Be in ETFs in your brokerage. Okay, the other one. I can't tell you how many times I see this done wrong, to the point that I actually prepare this for CPAs to make sure they get it right, the Form 8606 for backdoor Roths. So you make a non-deductible IRA contribution, meaning you don't take the tax deduction, and you convert it to Roth. Because if you're over a certain income limit, I'd have to look those up. I'm not going to right now. But if you're over a certain income limit, most of our clients are, you can't directly convert to a Roth. So this is how you get around getting money in Roth if you're over the income limit. So you do non-deductible contribution to traditional IRA and convert. But so one, income's to 1099, shows taxable amount. Let's say you do $7,000 to a traditional IRA and convert to Roth. Well, it shows it's taxable. And then the CPA just puts it as $7,000 taxable. I've seen this day in, day out. You need to file Form 8606. You also can't have any traditional IRA balances because, Dave, what is the rule? What's it called?
The pro rata rule.
How many times is this? How many CPAs and advisors don't know about this rule?
There's a few. It even trips up me if I'm not looking carefully enough. Because if you're giving planning on the fly and you're talking about it, if you're not very cued into what a client's accounts are and how they're invested, it's easy to get this one wrong.
So the pro rata rule is basically if you have a balance in any traditional IRAs that includes SEP. You know what isn't included in this though, which I'm happy about for many reasons, but is inherited IRAs. That does not count. But pretty much any pre-tax IRAs, if whatever your portion of your traditional IRA, let's say it's 90% of your IRAs are pre-tax, 90% is taxable when you convert. That's the pro rata rule. You have to look at everything. And so to be able to do the backdoor Roth and not have it be taxable, you have to have it in 401ks or have no pre-tax IRAs.
All right, give a numerical example of this, because it's not easy to follow sometimes or audibly. So give us some math.
Okay. So let's say, Dave, you have $100,000 in traditional IRA. What you did this year was you had 93,000 of it was, pre-tax money. But you were like, I'm going to do the backdoor Roth this year. And you added your $7,000 to do your non-deductible IRA contribution. So you have $7,000 that you didn't take a tax deduction for because you're going to do a non-deductible IRA contribution and convert it. You're going to do the backdoor, but you have $93,000 of pre-tax traditional IRA where you took the tax deduction. You go and convert that 93% is taxable.
So you essentially paid taxes on the money to put $7,000 in that IRA, and you converted it and you paid taxes on $6,500 of that money again to move it into the Roth IRA.
It's so bad. Like there's so many gotchas. And if someone's at like a 37% tax bracket, even 35, 7,000 taxable, that's a lot of extra taxes someone's paying unnecessarily. What is that, $2,000 or $3,000? Like this is material. Mm-hmm. I don't want to pay an extra $2,000 or $3,000 of taxes if that's not correct. So
exactly.
So So, I mean, it's a pretty easy workaround. You just roll traditional IRA pre-tax balances into 401ks. So solo 401k or your 401k at work, can have zero, and voila, the backdoor Roth is not taxable. So that's the workaround. Let's go into a more exciting one on the investments, Dave.
So if you don't do asset location correctly, and we'll talk about what it is, you're going to be paying more in taxes year after year. So asset location is where you put certain investments in certain different accounts. So asset allocation is where you invest. Asset location is where those investments go. So typically, IRAs should be holding investments that are tax inefficient. So they're throwing off income taxes all the time, not capital gains, but income taxes. Taxable accounts, such as a regular investment account, that is tax efficient because it's going to be taxed each year. So you want the lowest amount of taxes you can. A Roth account, you want aggressive investments there. It doesn't matter what the tax consequence is going to be, income tax or capital gains tax, because you're never paying taxes on that money again. So you want to give it the biggest runway to grow and leave that alone as much as possible. If you don't do that, then you're just creating more taxes, and it's unnecessary.
And I get it. It probably makes rebalancing and all of these things complicated, but it's material for clients. Like, okay, let's talk easy. Bonds, where do those go?
IRAs.
Exactly. Where the highest tax rate is, right? Not only because they're giving off interest, which is taxed at ordinary income, but also because there are stabilizers and they don't grow as fast. We want the things that don't grow as fast at the highest tax rate, and the things that grow the fastest, like growth stocks, value, small cap, those are in my Roth. I normally can't put that much in Roth, though. They normally have to also go on brokerage, but I don't have.
There are limits to it, though. Like if you have to be very careful with, okay, so let's look at asset location, but if we can't design a portfolio that perfectly, then we have to change the investments to match the taxes. So if we need some bonds to go in a taxable account, if that person is in a high tax bracket, you better be making them municipal bonds so there's minimal taxes with the distributions and selling them and whatnot. If you're leaving them as taxable and just shifting it from one account to the other, you've just made the allocation the same and increased the tax bill. So you did not do your job effectively as an advisor.
You know what? I think I've seen that before, actually, where like they're not put in municipal bonds in brokerage accounts. I just thought about that. Clients that come over, that is actually a common thing I end up switching. God.
The reason I see it happening is because it's ETF bonds, so there's not as much distributions going on. But where you have mutual funds, then it's just ugly. And it's lazy, honestly.
Yeah. So yeah, that's another one. Putting rental real estate in IRAs. No. The CPA has a client who has a rental property in his IRA, which requires a roof replacement. The cash in the IRA account is insufficient to handle the expense. What are the parameters for him to help the IRA without triggering any self-dealing or other tax issues? So everyone's just like, what, Heather? Oh,
yeah.
Yes.
What did you just say?
I know. Welcome to the tax code. One of our experts, he's like in his, I would guess, 70s in our Arizona like CPA forums, and he speaks a lot, has a blog. Here's his answer right away. Absolutely no good one. Like there is no good solution for this client. Basically, it's a prohibited transaction. You can't lend the IRA money. And it could be an IRA violation that would trigger an immediate distribution of all assets held in the IRA. Could you imagine if you had to take this rental property and take it out of the IRA? Let's just say it's like a $700,000 like rental property that you've been paying down basis on forever. But you don't even have basis in an IRA. Like it's so complicated because you can't depreciate when it's an IRA. You can't take any of the tax deductions. Like, so yes, if you ever think of putting rental real estate in an IRA, first of all, not tax efficient because rental real estate is capital gain property. You get depreciation advantages. If you put it in an IRA, now you've put this asset that's normally taxed very efficiently in a account that is always going to be taxed as ordinary income. Like not smart. Okay, that was another tangent. Sorry, I just I can't help myself.
You're passionate about these things. I like it.
Because so many people get it wrong. And then I get even more sad when I read what I read in the CPA journal today. And I'm like, I don't know if this is going to get any better unless we literally in the US decide to go to a fair income tax, like flat tax. Oh, flat tax. That's what they're called. Not fair. Flat. Like our tax code's getting more complex and we're getting less CPAs. This is a problem. Okay, this one. Not planning for RMD. This is definitely you see this probably way more than I do.
This one got more complicated recently. So RMD rules used to be 70 and a half. Then they changed it to 72, 73. Maybe if you're young enough, it could be 75. The amount of people who got confused about should I be taking an RMD was a lot. So people are like, well, do I take 2 when I'm 72? No, you just take 1 because there's no 70 and a half anymore. And then people didn't take the RMD, which then led to penalties on your tax return because you didn't take it and you should have done. And now they're just lost. All because the IRS was trying to be nice and kind.
Okay, I do this for a living and I still have to recalculate the RMD and go into like the Schwab RMD calculator and double check my work and sanity check because they've changed the law so many times. Yes, and RMD penalties are huge. Also, I think they've changed that. I think when they did this inherited IRA RMD thing, that they changed it to the 10-year rule, though, not for retirees, so people don't get confused, just inherited IRAs. But the IRS had to be like, we're waiving penalties for X amount of years because they're like, we've made this too complicated. Yeah. The other one I'd say on RMDs is, I think people make the mistake as retirees of not taking out of their traditional IRA accounts because they don't want to pay ordinary income taxes until they have to, until the required minimum distribution RMD takes place.
Mm-hmm.
But that's not a smart strategy. I mean, based on what we know today. I mean, sure, if they lower tax rates to 15 to 20%, I don't see that happening. If they do, I'll eat my words. But, I've had it where a client came to me and I didn't realize because I hadn't been their advisor all year. When I went to do their tax return, I was like, you guys reported no income last year. I mean, you had some, but like you were below the exemption because we didn't pull. I wanted to pull. I would have pulled for my IRAs at least to get them into the 10 to 12% tax bracket. Pay some at a lower tax rate, right? That's like giving money away at 10, 12.
Yeah, people think that paying 0 taxes right now is awesome, but then they don't realize they torpedo things later when they're forced to pay 24 to 32% because that's the required amount they have to take out. So it's not always the case. Paying a small amount of taxes now is okay to help you later on.
Love it. All right. I could keep going. I think I'm going to have to do one on business owners as a separate one of just let's dive in on this because that's already a lot for people. Really quick, can we talk about the donations though? There's mistakes on charitable donations a lot.
Yes.
Since you are Mr. Giving and want to give away $100,000 every year, eventually.
Per year. Definitely eventually. Not happening now. There's this, and then we need to talk about missing payments and carry forwards. So we'll do this one first.
Yes.
So this depends on whether you itemize or you take the standard deduction. If you take the standard deduction, none of your charitable contributions are deductible. Mm-hmm. It doesn't matter. It's only an itemized deduction. So let's say you have enough with all of your other deductions that you're going to itemize. And you decide to donate $50,000. We'll just play with numbers. And that gets you just over the threshold to start itemizing. Play a different game. Don't donate $50,000 this year. Wait and donate that amount January, February next year, and then do your donation for next year in the latter half of the year. So now you got $100,000 for your tax return next year. And now a lot of that is going to be itemized. I've seen people do little donations year after year, and it just either is not itemizable or they could have got far better tax benefits if they'd have lumped it into 1 year versus spreading over 2.
And to give people context of amounts, I just Googled it. So the standard deduction for 2025 is $30,000 for married and $15,000 for single. So between mortgage interest, property taxes, and charitable contributions, if you're married, you have to have over $30,000 for it to make sense. And you're limited at 10, right? And for state taxes, that's the cap.
Mhm.
So, and with where many people's interest rates have been, mortgage interest isn't that high unless you've bought a house recently or you didn't refinance. I hope that wasn't the case. But most people with 3% mortgages, mortgage interest isn't that high. So many
Right.
people are taking the standard deduction right now and not getting the benefits of charity.
All right, last one. If you've made an estimated payment this year, please make sure to record it and make sure it goes on your tax return. The IRS will eventually figure it out, but then you have to play with that mess. So keep good records there. The thing I've seen most often is carry forwards that people just don't realize. For my clients, it's charitable carry forwards. You have to make sure that you're pulling that forward on tax returns if you're the CPA. And if you don't, it's just lost.
Especially if
most of the time it will carry forward, but
yeah, especially if you move CPAs. That's the thing where I notice it the most. Like software will pick it up year after year if you're with their same CPA, but if you move CPAs, they're so busy and just trying to survive, they miss the carry forwards, the capital gain carry forwards, the charitable carryovers. If you had investment, interest expense carry, go on and on. There's carry forwards that if you couldn't get the tax deduction in that year, many times you can carry it forward. And if that's missed, it can be material. So I can't preference enough having an advocate for you for taxes and a good CPA is just so, so, so important.
All right, we're going into our question segment. I'm aware, and we are aware, that was a lot of content. So we're doing 2 questions today in our segment called What Would You Do? Our first question, Heather's reading to me, and I'm going to give the best answer you've ever heard. Go for it.
Okay. I hear people at work talking about doing a mega backdoor Roth conversion for their 401k. What is this, and how do I know if it's right for me? Dave, is it right for them?
Well, the mega backdoor Roth conversion is a secret society that exists in the upper echelons of the U.S. No, it doesn't. Essentially, what you're doing, a Roth conversion, you're making the non-deductible contribution to your IRA and you're converting it to the Roth IRA. Similar thing, but you're using a 401k now. Let's say that you do your pre-tax contribution to your 401k, you're under 50, it's $23,000. That's not the top limit you can contribute to your 401k. You can make after-tax contributions to your 401k. You just pay tax on the money now, put it in the 401k. To do the mega backdoor conversion, you then take that after-tax money and roll it out to a Roth IRA. Has to be written into your plan code in your 401k, and you have to make sure that you are meeting the limits of the 401k funding, but you're essentially bypassing the funding limits on a Roth IRA and just mega funding it each year. Is it right for you? Yes, if you want to save a lot of money. If you're lopsided in your savings and you don't have enough in Roth, if you have excess income that you're not sure what to do with it, yes, yes, yes.
And if you are already also putting enough in brokerage too. Something I always have my clients ask when we're thinking about doing this is when they convert. Because if they're only converting once a year, that's not great. I like when they convert, the after tax right away, every pay period. So it's not, having too much earnings stuck in there, if that makes sense, right? You want to convert right away before the earnings happen.
All right, let's move into highlights. This is the personal section of our podcast where you get to know us a little bit better. Heather, do you want to do your highlight first?
I do, and you're going to laugh when I tell you what it was, what it is.
Do it. Go for it.
Okay, Dave, I went to the grocery store by myself.
Boom! What?
I know. It's not very exciting, but hold on. Let me just describe. Okay, in the last 3 to 4 years between having twins, my business growing, all of these things, my husband has taken on a lot of the grocery shopping, or we're pulling the kids all together because none of us want to be left at home with the twins. I love my kids, but twins, when they're younger, one-on-one, like 2 against 1 was a lot. And so, but this time my husband was like, nope, you go. I don't want to go. And I went to Whole Foods at 5:30 at night. after work. And I was like, wait a minute. I don't have to dash in here. My kids are older now. I can actually meal plan. And I got to meal plan. And my husband came back and he's like, I thought you were just going to pick up eggs. And I came back with $200 worth of groceries. But I was like, yeah, but honey, I got the next 3 dinners. And he just looked at me like, wait, what? And like, he went to the grocery store, but it's just not in my husband's planning mentality. I don't think many men are, but he doesn't do the meal planning. And so we were
Careful.
Well, okay, fine. He doesn't. And
okay.
I'm the planner in the household. Let me put it that way. But point being, I got to go to the grocery store and I just remember the switch going, my kids are older now. I don't have to rush. My husband's okay. And I can meal plan. And I leisurely went grocery shopping for 30 minutes. And this whole thing that things don't get easier when your kids get older is a whole ton of BS. It is totally easier. Totally easier.
Okay.
That's my win.
I'm glad for you. I'm glad.
I'm still coming to the realization of this big change in my life, okay?
Yeah, it does get easier. I agree. There's less people hanging on your ankles. It's great. Then they just hang on your wallet.
Wait, so I take it, do you meal plan?
I have been known to meal plan and meal prep, cook it all.
That is amazing.
And then it's all in the fridge. People just take it when they need.
But you're a planner. You're a financial planner. You plan. So yes, that makes more sense. Okay, keep going. All right. What's your win?
You're not going to appreciate my win. I'm going to tell you that right now. It's going to be for a small subset of our audience who are male, most likely millennials, who like video games. So let me take you through this journey. Every Tuesday night, there's a group of 4 of us who game. For the last 4 years, we've been playing Call of Duty. It has progressively been getting worse and worse. We've been getting more frustrated, and the game has just been getting terrible. We switched 3 weeks ago to play golf because PGA 25 came out. We now game more frequently. We're more relaxed playing, and we're actually nicer to our spouses when we get off the game because we're not frustrated. And it's changed our whole gaming experience.
I'm happy for you, Dave. And all of that meant nothing to me.
Like I said, small subset of the audience is like, oh, maybe I should go try that game. Yeah, you should.
Okay. Well, I'm happy for you. Change is good.
It is.
Okay.
And Call of Duty is trash. All right. That's the end of our podcast. Thank you for listening to this episode of the Playbook of the Wealthy. You can find us on whichever platform you listen to podcasts, and the video version of the show is on YouTube, Instagram, and LinkedIn. If you want to send an email to the show, contact us at hello@playbookotw.com, and we'll see you next time.
Toodles!